All right, so the S&P 500 finished, well, we don't know if it's finished, but it's been on a really good stretch over the past 3+ weeks. I'm going to break down that stretch, its significance, and how unique it's been across a multiple ways. I'm going to show you all the different factors, just how strong this move has been, just how unexpected this move has been. This size, I mean, whether it's a bullish move was expected. We even talked about the bullish move occurring on that week that ended October 27th. The size of the bullish move obviously is something nobody expected because of how much the markets were pricing in according to the one standard deviation volatility levels on that last Friday. So I'm going to break all that down to kind of see just how significant this move is and whether or not it's got the staying power, right? Whether it's, there's enough, we've had enough of a washout to begin with that warrants this type of move, or as we've seen in the past when we've had these types of moves, because it's hardly the size of the move is not unique, it's the combination of other factors. But when we've had the size of these moves, they've ultimately ended up failing when not coming off of washout lows. So we'll compare and show some of those things, give you a Thanksgiving weekend. Of course, over this break, for the rest of this week, we do have our Black Friday sale on. I'll show you how to do that here in just a second. 20% off of our premium subscription. So make sure you check that out, and let's go ahead and get started. Today is Wednesday, November the 22nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Take advantage of our Black Friday sale. You can see up here at the top of the bar, it's got the coupon code. Click on this orange button there. It takes you to this page, and you can come down here to the bottom. You see the coupon code is Black Friday. After you fill in everything here, come down to the bottom, click on that Have a Coupon, and type in your Black Friday code, and then you can be able to choose how you want to pay for it. If you want to see what we have available for our premium subscribers, click on the word pricing here. It opens up this tab, and you can see what's available for all the tools and different things that are available for our subscribers, and how that compares. Again, 20% off of this, and how that compares to ends up being about 90 some odd dollars a month with the discount, which is a lot more favorable than the updated inflation adjusted monthly subscription. All right, let's go ahead and get started with the looking at the S&P 500 with the market forecast indicator. So we were up 15 days. This is our 15th day. We've only had 3 down days this entire 18-day rally. In fact, I noticed here there's a tweet that was posted out here that we were up 10.8%. I tweeted about that as well, 10.8%. There are lots of 18-day stretches where we've gained 10.8% or more. That's not, it is rare, it's not unique. But there are no 18-day stretches that gain 10.8% or more that also closed higher 15 out of 18 days. This is the only time that we've had this big of a rally over this small of a time frame where we are up pretty much almost every single day. This has been that strong of a run. And again, it's one thing to think about, again, just how strong it is, but every other time, and that's kind of what I tweeted out earlier, every other time that we've been up this much, so you see right here, this is the largest 18-day run since the 10/30/22 low, or 2020 low, where we rallied almost 11%. Again, almost the exact same time frame, right? The very end of October. We started, the low point here was October 27th. That low point was on October 30th. But we rallied 18 days, 11% off of, again, that was the election of 2020, the vaccine approval and rollout during that time frame. The VIX was at 38 and 105% relative to the VIX 3M. Here, I'll show you on this chart to kind of give you an idea just how rare this move is. So let's come over here. And let's look at the daily chart. Let's go out again 5 years, and we'll go to a daily chart 5 years. So again, coming off of the low point of October 30th, right there, you can see the VIX was at 38. You can see, again, 38, and then over here it was at 105%. We closed right there at 105%. Now, over here on October 27th, we were at 21. So, dramatic difference. And we are not only not at 105%, we were not even above 100%. We were at barely at 95% on 1030 right here. We're barely at, in fact, we were slightly below 95%. And then when you look at the VVIX, where we were on the VVIX on that time frame, again, the VVIX on that day on October 30th, 2020, right here, was at, 100 here. Let's just go VVIX. On October 30th, the VVIX was at 145.24. So 145.24, and over here on October 27th, the VVIX was at 102. So dramatic difference between the runs. So not only is this a unique run that is a unicorn. There literally has not been a run like this that has gained this much over this short a time frame where we've gone up almost every single day. But to add on to that, the fact that the VIX was so low when this run started. So again, it makes this run even that much, again, here's the month of November. How much we've gone up already in the month of November, 9%. Out of what? 240 months in the past 20 years. 240 months. There's only been 5 months that we've gained more than what we've already gained this November. Only 5 out of 240 months have we gained more than what we already have gained with 4.5 days left in the month. 4.5 days left month. Here's where the VIX was in all those other days, including that the October time frame. Here's where the VIX was in all those days. Here's where the VIX was when this month started. We were not at 21 anymore. We were at 18. So again, it kind of goes to show just how unique and rare this move has been over the past 18 days, and the rally and just coming out of nowhere. Yes, there were clusters, but clusters don't mean we're going to go up this much this time over this much. And yes, we can go up this much if the VIX were like say at 31 instead of 21. But the fact that we were, in fact, if you look at this, so for the move off of that December 27th low point, so this is the end of the 27th, the beginning of the 28th. Was a Saturday, where we closed on that Friday at 410.68 all the way up to now, so this is through today, the beginning of tomorrow, right? The VIX would have had to been at 27 points higher. So to get to, for this to be a 1 standard deviation move, the VIX on that day should have been right around 47, 48, over 48, just a little bit over 48. Instead, the VIX was only at 21. So again, that goes to show just how significant, well actually, excuse me, it'd be 26 points higher than where it is right now, and where it is right now is just under 13. All right, so the VIX is at just under 13. So 26, it would be at 26 points higher than that would be at, not 40, it'd be, 40. The VIX would have had to been at 40, roughly 40, for us to have that kind of move, right? This 2 standard deviation move to the upside. But instead, the VIX wasn't at 40, it was at 21. So it kind of goes to show, again, literally how this kind of move just came out of nowhere, because of, again, how low volatility was going into this move, where we were, again, with 2 clusters, back-to-back clusters, and how far below the moving average we were. Now, we weren't 5% below, and we're not 5% above right now, but we're pretty darn close. And you can see that is an upper limit of what we've seen in the past when we've been 5% above the 30-day moving average. In fact, not only are you 5% above the 30-day moving average, but you can see we're also well above some of these really short time frames too. Like, for example, the 17-day moving average here. We had gotten at one point here going into last week, after that big gap up higher, at one point we were nearly 5% above the 17-day exponential moving average, which you can see is very, very uncommon for this kind of move. If you follow my cursor all the way to the left, you can kind of get an idea of this is about as high as we get above the 17-day exponential moving average, especially with the stochastics as high as it is. So again, dramatic move to the upside that the market was not priced for, not in the least bit. Because the market was kind of bearish here, and it seemed a lot more bearish than it was because we were hardly washing out there with the breadth. Breadth wasn't too bad, and some indicators breadth was worse than others, but we weren't like washing out to the downside. But in the VIX, as you saw, we weren't washing out with volume. We weren't washing out with range. The range wasn't very big. The average, the ATR, and so. And then boom, 18 days. And we'll see again if we end up, because we've essentially have pulled forward almost 2 months of gains based off the volatility levels on that day. We pulled forward 2 months of gains in the past 3 weeks. So how much, like, are we going to fall back to pace eventually is obviously the question. If you look at the Russell 2000, you would say probably, because the Russell 2000 is already showing weakness. Again, it is above the moving average, not as much as it was over there. But the MACD, the stochastic, or excuse me, the near-term line, sorry, has already crossed below the intermediate line. Is still below the intermediate line as it's trying to figure out whether it wants to peak or not here in the upper reversal zone. Market sentiment is actually still in the lower reversal zone. So, and we got that long upper shadow last week, and we haven't been able to clear above it, and we're just kind of stalling up here in this area. So we're not building on that one big gain that we had, you know, after the CPI report came out last week. If you take a look at how the week is going here, again with half a day left of trading, a very good sized candle. Again, the second candle in a row of 3% or higher. The moving average is at 3%. That's a strong. The 3-period moving average is strong. Is at a high level. Again, we saw that in August. Getting below the moving average is a sign that we are turning over. We're starting, you know, that will transition. That will have a transition candle. So look for next week to be either a transition candle like this, where we get an upper lower shadow. Most likely, it's going to be a transition candle where we end up with either a lower high and or a lower Hakinyashi close before we ultimately get the transition candle. So something kind of like where we get lower highs here or lower closes, kind of something like this over here. Usually that lower close will end up with a lower shadow too, but I would look for that type of pattern to develop as the size of the candle breaks below the average, the 3-day average, which, as you can see, tends to lead to these bearish runs over the last so many months here. Let's take a look at the 3 green arrows. Of course, 3 green arrows across the board, continuing to be the case. Histograms are falling all over the place, so we're in early stages of convergence when the histogram falls. Of course, the next stage after the histogram falling would be for the actual MACD to cross below its moving average. So we're not there yet with the index, of course, well above the 17-day. So we're not there yet. But we are in early stages of convergence as we've already peaked on the histogram. The peak on the MACD usually occurs after the peak on the histogram, as you can see. Peak on the histogram, peak on the MACD, peak on the histogram, peak on the MACD, peak on the histogram, peak on the MACD. And you can see when the MACD peaks is usually when the index itself peaks. So we'll see, you know, if this ends up being a peak, especially considering how bullish the stochastics is. This is one of your stronger stochastic runs that we've had. We've been way up here above the 90th percentile for a very long time. You know how many days in a row now? It's just been one, two. You know, we've been above the 95th percentile. Yeah, the 95th percentile here for 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row. That's a pretty good run. As you follow, if I were to draw, put this line here at the 95th percentile for the stochastics, you can see again 9 days in a row. Like, we don't have that kind of run all during this past year. If you go back 5 years, let me zoom out a little bit. So again, just a reminder, it's how many, you know, all those days in a row that we've had. You know, we had a pretty decent stretch there in August of last year, but not 9 days in a row. Only 1 day there in May. Quite a few days in March. You know, 1, 2, 3, 4, 5, 6 out of like 7 or 8 days there in March. We were in a row. That's kind of the closest stretch. Of course, here's another one here in October of 2021, where we had a long, good stretch of however many days that was in a row. Only 2 down days in that big long stretch. Above 95 for quite a while before it finally broke down. And you can see we went sideways, went into correction mode. So kind of like what appeared to be this kind of like, oh, we're going to be breaking out here. Very similar time frame, end of October going into November. And then, again, we weren't able to build on that and keep going higher. And you wonder if that's the case this go around too, with how many days in a row. Again, it's not common, and it kind of shows kind of a little bit of an exhaustion when you're that bullish. When you come down to some of these other oscillators, of course, the DMI is bullish. We're not quite above 40 in the positive, but we are well below 15. When I break this out into the half of it, right, kind of a short-term look at the DMI, this is more of an intermediate-term look. If I can actually type here, I can bring it up. There we go. So cut it in half, cut the DMI in half, and you can see the ADX here is at 59. We did get the ADX got up to 61 over here going into June expiration. So here we are going into November and coming out of November expiration slightly. We also came out of July expiration with a very strong ADX too, and we'll see again the negative indicator. We're getting now 6 arrows down here, which again is more than any of these. If I were to bring this out a little bit more so you can see some other examples of how, when we've been this bullish, there's that same 2021 time frame, and we only had a few arrows there. We had some arrows here in August, and we didn't get any in March, just one arrow in March there. And here's another one where we got a bunch of arrows and a very high ADX going into 2020 in a decline. So you can kind of get a picture of, what type of move we can get coming out of this once the run is done to the upside. And of course, the runs like these parabolic moves always last a lot longer than what you think they will last. RSI is above 70. CCI is not above 150. That is, again, a rare combination. That usually does not happen. In fact, here we are with the weekly CCI above. So every time this turns green, you can see that's when the weekly CCI gets above 100. If you look at these other instances, when the weekly CCI gets above 100, that also typically coincides with the daily CCI getting above 150 and the RSI above 70. So when that weekly CCI makes that bullish move, the daily gets above 150, the RSI gets above 70, the daily gets above 150, the RSI gets at least 270 there. Here we are again. The RSI gets to above 70, the weekly CCI crosses above 100, no move above 150 on the daily. So again, a combination that shows some cracks in this bull move that might not be as bullish as we think it is. Looking at the Ichimoku cloud, we have the close to a mature trend strength on SPY. We have an intermediate trend strength, but still in the cloud on IWM. So a little different scenario there. And then looking at the Bollinger Bands and the Keltner channels, again, this is a very, very strong bandwidth, which again is rare to break through the 150-day highs of the bandwidth with a bullish move. And yet we did it. Again, it's that's not common, and it might not hold up because they haven't held up in the past when we've broken through the 50-day range, especially when you never did get above the 90th percentile of that Bollinger bandwidth. Not one day of this rally have we been above the 90th percentile of the Bollinger bandwidth. Very similar to last March. Very high momentum, so we should have. We've been above the Keltner channels for a long time, so we should have, but we just never have. And then you look at like the 4-week range, again getting a new 4-week high point. The 4-week low is almost to 0. One more day down there to 0. But here's another uncommon move, right? It's uncommon to get above 10% on the price width of the channel width of this past 4 weeks on a bullish move. It typically is a bearish move to get you above 10%, not a bullish move. When they have been rare, those rare bullish moves, they don't start. They usually start from already high levels This one started from below 5%. So this is, again, another one of those unicorn moves where we were in a very small range. It was a bearish move, a correction that did not produce a 10% move. I mean, again, you look at all the bearish legs lower last year during last year's correction. Right here, you can see the first leg did produce a 10%. Right there. The second leg here easily produced a 10%. The third leg lower here easily produced a 10% plus move. Here's the first leg lower, and we didn't even come close to a 10% move. Not even close. In fact, now we have a 10% channel width, and it's on the bullish bounce, not on the bearish move. So very odd, very, very odd moves. Of course, the volume is just tapering off like a rock, partly because of the holiday, but look at that volume tapering off. The range is tapering off. In fact, the range has dropped down to less than 1%. So again, a correction, see, pullbacks get above 1.5% on the ATR. This corrections usually get to like closer to 2, as you see again. If I were to zoom out, so you can see some of the other examples. Here's a correction well above 2, correction, pullback above 1.5%. Some of these other pullbacks here also above 1.5%. This correction, very, very weak correction, didn't even get above 1.5%, and we're already below 1. So the ATR here at less than 4.5, where that's less than 1% of 455. So that's a very interesting move. Again, getting below 1% is very significant in terms of the beginning of trends. But that's when you're coming off of a significant peak in the relative ATR, this ATR to price ratio, and a significant peak in volatility index, which we haven't gotten. In fact, here we are closing above 13, or closing below 13. Last time we closed below 13 was September 14th, and that's what the VIX did coming off of that. We were below 85%. We're lower now. We're lower there. And if you look at, see, that was 914. If you look at where the VVIX was on 914, right here, you can see the VVIX was right around a little bit lower than where we're at now. So the VIX, this again, the last time the VIX was this low on both an absolute and a relative basis, it led to a move higher, pretty much a full month move higher in volatility, and we'll see if that ends up being the case this time around. Again, very, very low level to get below 13 already. But again, it goes all the other times that we've been this big of a drop in the VIX over such a short amount of time has generally come when the VIX is coming off of a significant high point. And again, the VIX high point 18 days ago was only at 21.7 or 21.27 actually when the 18 days started. And here we are down nearly 40% on the VIX in that time frame. It's again, you can see how the VIX does not drop this far off of this low levels. We have dropped this far before right there, but off of much higher peaks. Here we dropped that much in March. Here we dropped that much in December. And you can see when we have dropped this much, we generally bounce up pretty significantly. And that was when we dropped to 16 or when we dropped to 19, and we're dropping to 13 here with a very, very low level on the VIX. Again, in 18 days, off of such a small peak that we have. All right, now if we take a look at what's driving this price action, of course, we pretty much know what's driving a lot of this price action. A lot of it has to do with the drop in yields, right? The rise in bonds and the drop in yields. So let's go back to that October 27th. So we'll start on the 28th, going all the way to now. And then we'll just stick with like a hourly chart here. So here's the returns. Again, the 13% for the Qs, less than 10% for IWM. International stocks are doing very well, and bonds are finally doing very well. Bonds are way outpacing HYG. TLT is. Now, granted, that's not the case with IEI, which is that's got a similar duration than not TLT to HYG. So it's more of an apples to apples comparison. You can see since October 27th here, if I were to go back to a daily chart, to like a 1-year daily chart here. you can see that this is, you know, very positively correlated to SPX, this ratio is, and here's October 27th. So from this period, that low point right there, there's the rally, and that's still, you know, in fact, it's at its highest level. So HYG corporate bonds are very, very high. In fact, the long-term PPO, which is diverging, is very, very high. In fact, what I just had on was the ratio of the Qs to IWM. And you can see the significant divergence showing up there, which also kind of stands out. Here's I had the weekly version of it. You can see the lower highs on the PPO, the MACD, with the much higher highs than that high RSI and CCI and DMI. Even the ADX is diverging. So, and the high long-term PPO on the weekly chart. So very, very significant divergence, a very big last leg higher here on this ratio chart over the past few weeks, and you can see that difference there. Weakness in commodities, weakness in yields, and of course weakness in the dollar. That's your three-headed monster that's been so bullish that's been so bearish for equities during this correction, has been very bullish for equities during this pullback. The dollar dropping to its 200-day moving average with the very low MACD dropping down here 26th percentile, and then of course you can see a little bit of a reversal pattern developing on the dollar. But that's the, you know, this filling in this gap. Here's October 27th right there. So filling in that gap has been a big reason for this move. The other one, of course, is TNX. TNX, here's October 27th right there. You can see we were at 4.84%. We're now at 4.4%, sitting on not on the 200-day moving average, but on Fibonacci support at the 38th percentile. And you can see the MACD histogram has already peaked, and now it's a matter of if and when the MACD itself ends up peaking there. And then finally, commodities. You know, the crude oil falling below its 200-day moving average, a little bit of an inverse head and shoulders short term. Forming just underneath that. We hit the 78th percentile of the retracement level of this rally we've had, but we're sitting now kind of around the 62. The MACD is already above its moving average. We're still below the 70, so we're already in convergence mode. So a precursor to a potential reversal on crude oil. So we'll see, especially with OPEC and what they have got going on, see if that ends up. You know, again, October 27th is right here, this peak right there. That was where we were October 27th. So we were already bearish, but that drop has put a lot of, has lifted equities. And now the question is whether crude oil will continue to drop down to, say, 67, which would be very bullish for equities. Will yields continue to drop, say, down to 4%, down to its 200-day moving average, which would be very bullish for equities? Will the dollar continue to drop below its 200-day moving average and get down to these 100 levels where we had the fake out breakdown there that propelled this bullish move? That's all the question. Getting below the 50% retracement of that bullish move. That's the big question, and it appears unlikely those three things will continue to happen. In fact, it appears that, you know, after some, you know, all these strong moves in one direction, that you know, there's appears to be the conditions forming for a reversal to occur on those back to the upside. You can see this has been a global phenomenon, not just in the U.S. If you look at the 12 grid, sorry, let's look at the 12 grid for all the major ETFs out there. Probably should eventually get rid of this Russia ETF. But you can see everything is dark green shading in a green line. We've got some clusters in some areas. China is the only one not participating. You can kind of see how it's still, you know, relatively bearish. Even Korea has been able to unshackle itself from China. Usually those two really move hand in hand, and that hasn't been the case. So China is still weak, and again, second biggest economy is not following what every other major economy is doing, and you wonder, you know, will that be a canary in the coal mine, that underperformance on China? Will it start to drag down on things that are trying to outperform without it? And then you look at the sector comparison chart, again looking at since that October 27th time frame up until now, it's all been these major indexes, XLK, XLY, XLC, and then you can see financials, real estate, interest rate sensitive areas doing well. Usually financials do better when interest rates rise. Real estate does better when interest rates fall. Interest rates have been falling, and financials have still been able to do well. So it kind of makes you wonder a little bit about that move. Energy weak, of course, that's over the last 3 weeks. If I were to look at just the last week here, starting on the 13th through now, you can see it has not been XLK, XLC, and XLY. Real estate's up there, materials is up there, financials is up there, so it's been a little bit more. Energy and staples still lagging, but utilities is doing well. So it's a little bit more of a rotation over the past little bit, as again, similar to what we saw with the major country ETFs, all the US sector ETFs also well above their moving averages, except for one, energy, which has been lagging behind. Staples ended up getting an overbought cluster this week. At one point in time, earlier this week, the S&P 500 had a cluster. It was yesterday here at the highs of the day. Let's see, was it yesterday? It was this day. It was this day actually, Monday. At the highs of the day on Monday, we had a cluster. We were above the 5% window, and the MACD was at 100th percentile of the past year. So, you know, that might be the washout move that we've seen here on Monday, as we saw on some of those sectors as well. All right, for our trade idea of the day, I wanted to take a look at Tesla. Tesla got a bear tag here. It's been bullish, not as bullish as the rest of the market. It's not nearly as above its moving average as it has been. Again, getting a bear tag, but not really following through on that bear tag. And of course, getting a little bit of an engulfing pattern here today. The near-term line coming down close to crossing below that falling intermediate line. So that's why we've got the light pink shading. We had dark green shading briefly, but we didn't ever have a green line to go with it. We're still above a falling moving average, which makes it yellow. And of course, the momentum line dipping down into that area. You can see the weekly chart. We got, you know, a good bullish reversal candle, kind of a good bullish candle. I mean, it was a reversal candle this week, right? We got the transition last week with the green arrow. You got a little bit of a reversal this week. We closed above the 10 and 40 week exponential moving averages. The PPO is moving slightly higher, but it was a lower high point, and so you kind of got a little bit of weakness there. That suggests another transition candle may be coming next week on the chart. When you look at the 3 green arrow chart for Tesla, we do have 3 green arrows. So the stochastics is very close to giving you a red, and then the MACD histogram is also down there, and we're a lot closer to the moving average now than we have been. In fact, when you look at the 2-line version of the chart, again, we're still above the 8-day moving average, but we try to get above the 50 now twice and failed now both times to get above the 50. With the MACD histogram falling and the stochastics already crossing below its moving average, suggests that we might be done with this little run to the upside. We might be having a little bit of a decline. If you look at some of these other oscillators, they also appear to be peaking. You know, we're back below 30. We never did get really below 20 on the negative DMI. Looking at the RSI and CCI, they also appear to be peaking at bearish levels, with the CCI already dropping below positive 100 and getting almost back below 50 on the RSI. And then from the Ichimoku cloud, you can see we're still below the cloud. We never did get through the cloud, and we never did get a bullish trend going. So you see how we're up against resistance in a lot of these indicators. Finally, looking at the Bollinger Bands and the Keltner channel, you can see we again are right there in the, we try to get above the upper quartile. We kind of failed there, and the momentum has been bullish and appears to be peaking, and especially with this reversal candle. So what I decided to do was to come down and do a bear call spread where I can sell that mid-30s delta, buy the 250. This is the setup that we ended up having for a normal position size, getting about $420. My break even, as you can see, ends up being above these highs. So if we break through this highs, break through the cloud, then I'm willing to lose 420 out of that $1,000. But if the resistance holds, if we can get 50% of maximum gain here really quickly, then we might be able to get 50% quit. I mean, again, it may, depending upon how bearish we are, even just on Friday, we can get it. You can get 50% of maximum gains on bear calls within a day or two if the move is right. Otherwise, it's still a pretty decent reward, even if we wait for the full maximum gain all the way to expiration date. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com, taking advantage of our Black Friday sale here over the weekend. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and happy Thanksgiving, and we'll see you all on Monday.